Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you're new here and enjoy today's video, be sure to hit subscribe and also hit like on the video. It does really genuinely help the channel a lot. So what we're going to talk about today is something that sounds awfully boring, and that is actually to do with fees when you're investing in a hedge fund or a mutual fund. So personally, I'm not currently invested in any hedge funds or mutual funds, but one of the guys I would love to invest with if his fund was no longer closed to new investors would be Mohnish Pabrai. So we're going to talk through his fee structure and how that stacks up versus the typical fees and what that actually means for returns for investors. So let's get into it. First, we're going to actually start off with a quick clip of Charlie Munger talking through this topic as well. So enjoy.
Concentrating in those few and rare wonderful opportunities. Do you believe that the 0.625 the 0.625 high watermark fee structure that the Buffett partnership popularized is the fair structure for both limited partners and the manager themselves? And could you also touch upon what fee structure you employed during your partnership? Thank you.
Well, I did copy the Buffett formula more or less, and I do think it's fair, and I think it's still fair. And I'm looking at Mohnish, who still uses it. You know, I think it is fair, and I wish it was more common. I basically don't like it, the business of scraping it off the top. If you're advising other people, you ought to be pretty rich pretty soon. Why would I take a lot of advice from somebody who couldn't himself get pretty rich pretty soon? And if you're pretty rich, why shouldn't you put your money alongside your investors and go up and down with them? And if it's a bad stretch, why should you scrape money off the top when they're going down and not? So I like the Buffett system.
So when you invest in a mutual fund, there's really two types of fees. There's a management fee, typically, and a performance fee. And with the standard sort of mutual fund or hedge fund, a very typical model with fees is they're going to take 2% for management and 20% of profits. That's pretty standard across the board. So what that means is the hedge fund or mutual fund is going to take 2% of all of the assets under management as a fee, regardless of performance. So whether they make you a lot of money or whether they lose 50% of your money, they're going to take 2%. And what they also are going to take is 20% of any profits that the hedge fund or mutual fund makes. So what that causes is a big sort of misalignment between the goals of the investor and the goals of the fund manager. The goals of the investor is obviously to make steady returns over time. The goals of the fund manager at that point become to make as much money as possible. And the way that they're going to make as much money as possible, in a lot of times or in a lot of situations, is going to be short-term speculation. If they're going to get 2% regardless of performance and then 20% of any profits, they're not going to be massively focused on downside. They're not going to buy with a margin of safety to prevent losing money. They're going to be focusing on the high flyers, the weed stocks, the Netflixes of the world, the Teslas, those types of things, to try and make quick profits and really get a lot of that upside, because they have no downside risk really with their fee structure. So it creates a big misalignment, and there is actually a fee structure out there that does align with investors, and it's something that actually came up in the original 1950s Buffett partnerships, and Charlie Munger actually used a similar fee structure as well. And the guy that we're going to be looking at today is a guy by the name of Mohnish Pabrai. You may have heard of him before, you may have heard me speak about him before. He's the author of this book here, The Dhandho Investor. Highly recommend this if you haven't picked it up already. And Mohnish Pabrai has basically copied the exact fee structure of the Buffett partnership. And the Buffett partnership had zero management fee, and it had a high watermark. So it had a high watermark at 6%. And what that means is that Mohnish Pabrai and Warren Buffett and Charlie Munger back in the day as well didn't take any fees at all until that investment fund returned at least 6% each year. So over and above 6%, they then took 25% of the profits, but up until 6%, they didn't take anything. And they also had, like I say, a high watermark. So what that means is if Mohnish or Buffett loses money one year, they actually have to get all of that principal back plus an extra 6% before they actually start to earn fees over and above that. So I'm just going to jump over to the computer and run you guys through some numbers of how that looks in practice. And it's really cool in the way that it sort of aligns the incentives of the investor with the fund manager. Mohnish has his own money invested in the funds that he runs, and that's exactly what Warren Buffett did as well. So it's a really good incentive for both people to have aligned sort of goals in their investment practice, and it's worked really well. Mohnish is a phenomenal investor. He came out, and I think it was 2013 off the top of my head. I'll link an article down below. He'd massively outperformed the S&P 500. I don't know that we've had an update since then, just because he does invest all over the world, so we don't see sort of all his investments. We see his investments in the States when the 13Fs come out, but we don't see what he's got in India and some other countries like that. But nonetheless, great investor, great mindset, great guy, and sort of some fantastic content on YouTube if you actually track down Mohnish's YouTube channel as well. So without further ado, let's get into the spreadsheet, and I'll run you through some numbers on how Mohnish's fee structure stacks up next to the typical kind of 2 and 20 split. Okay, so we're now over at the computer. I'm just going to quickly run you through a compound interest calculator first. I know I talk about these things all the time, so I'm keen to run you guys through some examples of kind of how the typical mutual fund stacks up versus what an S&P 500 index fund or something similar might do. So I'm going to run through an example first, just putting $1,000 into something like a very low cost index fund for 40 years and assuming an 8% return, what that would generate. So if we run a calculation on that, our $1,000 in 40 years time is going to turn into approximately $21,700. That's fantastic. Long-term investing in index funds just works. It has worked for a long time, and I'm sure it will continue to do so. So that's a quick example of that. The typical management fee in a mutual fund is actually 2%. So I'm going to drop this rate of return down to 6%, and you're going to see that this is going to have some pretty crazy impacts on the results. So first off, we're up with $21,700. If we drop it to 6%, we're down to $10,200. So it's pretty much taken 50% of your retirement money over that period of time, just for that seemingly small 2% management fee. So something to really watch out for, and again, it's something that doesn't align all that well with investors, is just scraping it off the top regardless of performance. So I'm going to jump over to another spreadsheet I've just set up here. Okay, so I've now come over to a spreadsheet that I've built around Mohnish Pabrai's fee structure. So I'll quickly run you through some of the inputs I've got here, and then we'll go through some actual examples of how Mohnish's approach benefits both Mohnish, assuming he does a really good job, and the investors in his actual fund, and it's just a much better option generally than mutual funds. So as far as the inputs, I've got a compounded annual growth rate, so the returns, the gross sort of returns that Mohnish is generating from his investment activities. The principal, in other words, the amount of money that Mohnish is managing. In this case, I've just got $1 million. He manages a hell of a lot more than $1 million. I think it's actually closer to more like $1 billion now. That's not public information or anything. That's, what people have sort of speculated that he's managing, but somewhere around that figure. He's got a minimum requirement return. So this is his sort of high water benchmark that I was talking about. So below a 6% return to investors, Mohnish takes this much money. He takes $0, no fee. But beyond that 6%, he takes 25%. And what you're going to see is that if Mohnish does pretty mediocre, the investors are going to do just as well as they might in an index fund. And if he does really well, the investors are also going to do really well, and Mohnish is going to do really well also. So it's really well aligned with the different kind of people involved in this arrangement, the investors and Mohnish. So let's start out with just a compound annual growth rate, or a return to investors of 6%, right in line with that watermark, slightly below the average, maybe in line with what we'd expect the S&P 500 to do in the future, maybe around 6 or 7%. And if we scroll down and have a look, that means Mohnish has made off this $1 million, he's made $60,000. The minimum requirement is also $60,000, so he's taken no fees, and the shareholders get all of that $60,000 return. Fantastic for investors, not so good for Mohnish. He hasn't made any money this year, but there's no fees that have been taken off the top, and this is actually a big competitive advantage if you're going to run a hedge fund as well. So this is quite cool to see. So let's start cranking up the returns. Let's go to 8%, just like we saw in the compounding calculator before. In a typical mutual fund, if the fund does 8%, investors only get 6%. In Mohnish's arrangement, the investors get 7.5%, so much better. And as you saw, those little 1 or 2% fractions make a big difference with compounding over time. So 8% there. If we crank this up to something like what we try and target, if you're a Phil Town fan and have read some of Phil Town's books, you'll know he targets about 15% a year. So if we crank up to 15%, you will see that the investors get 12.5%. So they've done well above the average, and they've really got minimal downside, assuming that Mohnish doesn't make terrible investments and lose all their money. They've got minimal downside because there's not a lot of fees involved, but they get a lot of the upside. So if the fund does 15%, the investors themselves get 12.8, as you can see here, and Mohnish is going to take out around $22,500 worth of fees. So he's going to take a quarter of all of the returns over and above 6%. Let's crank this up to something that it's been rumored Mohnish has been doing, which is more like about 28% per year. A ridiculous return, insanely good. He's one of the best investors on the planet. Unfortunately, we haven't had kind of an audited update of Mohnish's returns for probably 6 or 7 years now, just because he is a privately sort of closed fund. He's not looking for a whole lot of new investors at the moment, as far as I know at least. So, but these were the types of returns that this guy was generating in the early days. In his first 2 or 3 years of investing, he was generating 70% a year, 70. So pretty crazy numbers, but let's see what that comes out at. So if he does 28% a year, there's still the minimum of 60%. The investors are going to get 22.5%. If you can make a 22.5% return for any reasonable length of time, you're going to be incredibly wealthy pretty quickly. And Mohnish has taken home $55,000 in fees from that $1 million. So right around about 5% of all of the assets under management he's taken as a fee, and that's going to make Mohnish very wealthy as well, assuming he can keep that record up. So I don't have a huge amount more to add from that, other than just running you through some quick examples, and it is a very cool fee structure. So if we've got any wannabe hedge fund managers or mutual fund managers out there, maybe this is something to look at. It looks very attractive to investors, and it looks very attractive to the management, assuming that you have an edge in the investment world and can outperform the market. So that's all from me today. If you enjoyed the video, please drop it a like I said, and hit subscribe. You can watch, I believe you can hit subscribe probably over here somewhere, and you can watch some other videos I've made over here, so go ahead and check them out. But that's all from me today. Cheers.